Hello, I'm Regina McCann-Hess, and welcome to our Women in Wealth series. Today, we're going to talk about 401ks and traditional plans versus Roth plans. And I'm going to say 401k plans, but most people, if they have a retirement plan, if they're in corporate America, it's called a 401k plan. If they're in a nonprofit or they're a teacher, a lot of times they're called 403bs. They could be a TSA, a tax sheltered, and it's like all sorts of names out there. But just referring to it as a 401k is a generalization, but it basically is referring to your retirement plan through your work. And so there's traditional, which is what we all grew up with, and that is where you through your paycheck, you have money deducted and it goes pre-tax into the retirement plan, right? And then it grows and grows and grows over the years. And then you've retired later on. And then when you take the money out in retirement, it's been tax deferred. So all those years you didn't pay taxes on it. But when you're retired and you start taking money out of it, you then take money out, and Uncle Sam says, "Oh, guess what? I haven't gotten my piece of that pie, and it's time that you pay me for that." And that's good because you've deferred all those taxes all those years. But at some point, you got to pay the piper, right? So it is usually when you take money out of a retirement plan when you're retired or sometimes sooner, when you take money out of a traditional type of 401k or retirement plan, you will pay the tax, whatever tax bracket you're in. Now, if you tend to have a situation where you're taking money out before you're 59 and a half, and it's just like a one-time distribution, not your periodic distributions, that is going to also give you a penalty tax of 10%. So if I'm 54, right? And I decide, oh, I want to go buy a car. I'm going to take money out of my IRA or my 401k. Okay, that's great. Let's pretend I'm in the 22% tax bracket. Okay, I got to pay taxes on that. Okay. Oh, wait a minute. I'm under 59 and a half. I am also going to have to pay a 10% penalty for that. So now going to have 32% of that money tax, like 32 cents of every dollar is going to Uncle Sam. So it's definitely not something that we encourage people to do. We always say, hey, wait till your full retirement age. You can start taking money out after 59 and a half without that 10% penalty. But obviously, we like to hold on to that money as long as possible. So that's kind of how the traditional plans work. And most retirement plans are run that way. Roth plans came out many years ago, and they weren't mainstream for a while, but they're pretty much mainstream now. I think you'd probably have to be under a rock if you haven't heard about a Roth plan anytime recently because people, really like them. And it allows you to do the same thing. You have money come out of your paycheck, whenever your contributions are made to your retirement plan, it's through your payroll deductions. So it goes into your 401k plan. Now, if you're doing a Roth, it goes into the Roth bucket. So here's the difference. You pay taxes on that money today. So let's assume you do monthly contributions and your monthly contribution to your Roth is $1,000. And you're in a 22% bracket. So that means the $1,000 goes into your plan, but you also pay Uncle Sam his $220 because you got to pay your tax bill. So that's okay. You pay the tax bill now. And that money grows and grows and grows, deferred, deferred, deferred. But the difference here is you take when you retire and you take the money out in retirement, that money that you contributed plus all the growth, it comes out tax free. Now, obviously, you have to follow the rules and all that fun stuff, but it's money that is tax free. So you have now created a tax free income stream in your retirement, which is extremely valuable because every dollar really counts when you're in retirement, though you have to make those dollars stretch as much as possible. So Roth money is very, very valuable in retirement. So it's like the idea is traditional versus Roth. Think about it this way, now or later. I don't know if any of you are candy geeks like me. I'm a total candy like fiend. I'm 54 years old and I still eat candy every single day. Like Swedish Fish, hello, you're my bestie. Um, but there's used to be this candy called the Now and Later, which is why I have so much dental work in my mouth because you eat those things and you're eating them for like a long time and all the candy gets stuck in your mouth, right? So they call it Now and Later or Now or Later. So think of the traditional plan as the later part and the Roth is now. So the Roth plan, you pay the tax bill now. The traditional plan, you pay the tax bill later. So either way, Uncle Sam is getting his piece of the pie. You have to pay the tax bill, right? And it's a matter of if you want to pay it today or later down the road. So an example of that, let's just say that you're doing the full contribution amount to your 401k plan this year. And the full, assuming you're under 50, the full amount that you can contribute is $23,000. And we all know that if you're over 50, you can put more than that, but we're just going to say you're going to put $23,000 into your retirement plan. So let's assume that $23,000 contribution that you made this year grows and grows over the years and years before you retire. When you retire, that particular part of your plan that you put in grew from $23,000 to $46,000, right? And you've never paid taxes on this money. So you're going to take it out, assuming again, you're just taking it as a lump sum because this is educational, right? So at that point, you have to pay $10,000 or $10,120 to Uncle Sam because again, Uncle Sam's going to get paid either now or later. And in this case, it's later. So your tax bill on that money is $10,120. Okay. Now, same thing, Roth plan. You put the money in now, again, you contribute $23,000, it's a different tax year, pretend. And you pay the tax bill today because you're like, oh, wait a minute. I'm okay with Uncle Sam taking that money today because I want to, have tax-free income in retirement. So the IRS tax bill for that $23,000 calculation would be $5,060. So it's literally, half of what you would pay later on. So again, when that money grows, same scenario, you put 23,000 in, they still make you pay taxes. So the full 23 goes in, but you're paying taxes out of your out of your paycheck. And that money, same scenario, grows and grows over the years. It grows to $46,000. And then, after all those years, you're like, oh, I'm going to take it all out of that 40,000, that $46,000. Well, guess what? You have a zero tax bill that day because you've already paid taxes on this money. So that is the difference. It's very powerful when you say, okay, well, oh, the tax bill essentially is double versus paying it now versus later. And whether or not you want to pay that tax bill now versus later. Accountants, CPAs, they're educated and trained to save you tax dollars today. Financial planners like myself, we're educated and trained to save you taxes over your lifetime and talking about tax strategies for longer term periods. So this is where, the CPAs and ourselves, we kind of have a conversation. We're like, okay, well, this is what we think is good for the long-term plan. And they're like, well, this is good for the short-term tax plan. So a lot of times what people have done in a compromise to the financial planners and the accountants is they make contributions to both, which you can do. You could put like half your contributions to the Roth and half your contributions to the tax, to the traditional. And therefore you're paying a little bit of the tax bill now and a little bit of the tax bill later, but you still wind up with some tax-free money in retirement. So this is really, really important. It's something that you want to talk about with your accountant, something you want to talk about with your financial planner, your financial advisor. These are really good conversations for long-term strategies, long-term tax strategies, long-term financial planning strategies that are going to help you essentially with your cash flow in retirement. And, sometimes people will say, well, I'm not going to be making as much money. Yeah, for the most part, true, maybe. But so I'm going to be in a lower tax bracket. Maybe you might be, you might not be. We don't know where the tax brackets are going to go. But even if you are, you still need that dollar to stretch further when you're in retirement. So that's why we are very, very big advocates on contributing to Roth plans. And even if you're still contributing to a traditional plan, there's nothing wrong with that as long as you start paying attention to the Roth and maybe, taking some of that percentage and moving it over to the Roth so you can maybe get best of both worlds. There's no right or wrong. It's just, how you're going to look at it and how it's going to really fit into your plan. So that's kind of what our soapbox is for the most part on that. So those again things are very important. Like I said, you can split your contributions, talk to your accountant, talk to your financial advisor, have them talk to each other. There's nothing wrong with that, with them having a good old sit down like, hey, this is why we want to do this. And the accountant's like, well, we want to save some dollars on taxes, so maybe there's a compromise that they can work out. And at the end of the day, what benefits you on your journey and your long-term plan, could be beneficial for you at the end of the day. So we have that. So the other thing about that is, yes, potentially you could be in a lower tax bracket when you're retired, but here's the thing. Your Medicare premiums are determined by your taxable income. So if you have income or money taking out of your traditional plans, whether or not it's your 401k or IRA, your traditional plans, you have to pay taxes on that money. So guess what? That's going to increase your taxable income, which could impact your Medicare premium. So that's something to think about. Now, can you control that? Sometimes, yes. But once you get to required minimum distribution age, which for some people is 73 and some people is 75, once you get to that age and you still have traditional IRA or traditional 401k money, you are not in control of that. The government tells you, hey, this is how much you have to take out of your plan this year. You know why? Because we want our tax money. That's why. They have not taxed that money. You've been growing it for decades, probably. And they're like, hey, we need to get paid. So this is why you have to take required minimum distributions. And obviously, you're probably going to need it, to help your cost of living. But here's the thing, when you get to that age, you again do not control the amount that you have to take out. You are told how much you have to take out. So that potentially could put you in a higher tax bracket, meaning you don't control it and you don't know how that's going to impact your Medicare premium as well. Now, here's the flip side. The money that's in your Roth plan, whether or not it's a 401k or an IRA, guess what? No required minimum distributions. And even if you do take money out of that, it's not going to impact your taxable income. So it shouldn't impact your Medicare premium. So those are like little tidbits that people may not think about that are really, I think, could add value to your situation just by thinking it through and how it's going to impact you down the road and today and along the way. So, the whole tax deferred part is great. It grows and grows without Uncle Sam reaching in and taking money out. So now you just have to determine, how much of that money do I want to pay taxes on now? And how much of that money do I want to pay taxes on later? And oh, by the way, if you don't take your required minimum distributions, the amount that you're supposed to take out of your IRAs or 401ks, guess what? There's a 25% tax penalty. So Uncle Sam wins there. So you don't want to miss your required minimum distributions. Very, very a tough conversation to have if you go into that. So those are some basic tips. Obviously, you can also contribute to IRAs, whether or not it's traditional or Roth, in addition to your 401ks. Now, obviously, if you're contributing or part of a 401k plan, your contributions are not going to be deductible for traditional IRAs. So if you are able to make Roth contributions, that makes way more sense than traditional contributions, because you're not going to get the deduction anyway. So, those income limits are available online, and just, seeing how much you make as a single person or as a joint married jointly. I can't even say it right. Or married filing separately is a totally different ball game. You kind of pretty much don't have a lot of options there. And again, the Roth 401ks and Roth IRAs are exempt from the required minimum distributions. Another thing that I want to talk about on the 401k plans is company matching, which is great. It's free money, right? Free money. So if I run into somebody who's not doing their 401k and the company has a match, I'm like, okay, so do you not like free money? Because most people like free money. So 401k minimally should be whatever your company's matching. So if your company matches up to 4%, then 4% of your money really needs to go in there, because you just doubled your money right there. So no excuses. Let's do it. But the flip side of that problem is that sometimes people think, well, I'm only going to put in what my company matches, because that's all they're matching. So that's all I'm going to put in. And it's like, okay, that concept is not a great strategy, because the money that you contribute to the 401k plan is your money, regardless of how long you've been with the company, regardless of how long you've stayed there, or the short time that you've stayed there. Whatever you contribute is your money. The only thing that is vested is the match. And sometimes the vesting is immediate. It just depends on the plan. So either way, you want to make sure, that you're not afraid to put more money in because you think the company is going to take it. They're not. It's your money. The other thing is, are you really going to have enough money in retirement if all you do is what the company matches? So a lot of people get a little short-sighted on that. And I do have that conversation a lot with people. And a good way to do that, get around that is, have an automatic thing set on your retirement plan that every January you automatically go up 1 or 2% or more, if you can afford it, to increase your retirement savings. And of course, my 1/3 rule: if you get a pay raise or a bonus, 1/3 of that goes towards increasing your retirement savings, 1/3 goes towards your rainy day savings, and the other third, pat yourself on the back and go, put it into your lifestyle and spending, because you worked hard for it. And this also, not only does that save or help you towards your savings goals, but that also hopefully helps a little bit of that lifestyle creep that happens, and hopefully avoids you spending too much of, your new increased income on lifestyle, and puts more towards savings. So, long term, that really makes a difference. Part-time people, sometimes part-time employees think they cannot contribute to a 401k. Those rules started back in 2020, I believe. The Secure Act of 2020s did discuss part-time employees being able to participate in 401ks. So you may just want to double check with your employer to see if they do allow part-time employees to participate in the plan. It may be something that you may just have assumed that you're not allowed to participate in, but you are able to. So definitely look into that. And I believe, it was the Secure Act of 2020, but I think it started in 2021. So, it's 3 years ago. So let's get it on. Get that 401k going, even if you're part-time. Every little bit counts. The other thing I'm going to just talk about 401k plans is, and this is kind of goes back to why sometimes people think, oh, I'm just going to put in what the company matches, and, good that you're at least doing that, but you should and could do more maybe. But It goes back to education and the lack of education. And, sometimes 401k providers come in maybe once a year and there's talking about the plan, but maybe they're not educating you on why you should put more money into the plan because it's your money, it's your savings. And if we did maybe a better job of educating people about why retirement plans are so important for you and why saving for retirement is so important for you, I think maybe we'd have a lot more people saying, yeah, I maxed out this year. It's awesome. I consider it a badge of honor when I've hit my full funding for the year by September. I'm like, whoo, all right, I'm done. Right. So that may work for you. It may not. But I see a lot of different situations every day. Some people are very comfortable for retirement and some people may be working a little bit longer. And I will tell you the most powerful thing that you can do when you're doing financial planning or making decisions about retirement is to be able to choose whether or not you want to work versus having to work. So that starts with saving as much as you can for retirement and use those retirement plans. So our call to action today is look at your 401k plan, see if you have the Roth eligibility and consider whether or not it makes sense for you to do part of your contribution to the traditional and part to the Roth. And also, make sure that you're increasing your contributions whenever you get a pay raise and maybe even annually on purpose in January. So with that, I want to thank you for listening. Again, I'm Regina McCann-Hess, president of Forge Wealth Management, and you can find my website at forgewealth.com. You can follow me on Facebook, Instagram, and YouTube at Forge Wealth, and LinkedIn is Regina McCann-Hess. Go make it a great day.